Welcome to the Pearls of Wisdom podcast, brought to you by Southern Jewelry News and Jewelry Store Marketers. Hello, everyone. This is Guy with Jewelry Store Marketers, and we're here for another episode of the Pearls of Wisdom Jewelry podcast. And I am here with Elisa Dillon.
Hello.
VP of Sales of Southern Jewelry News and Mid-America Jewelry News, and totally awesome person everybody loves. So,
thanks, Guy.
Oh, everybody loves Elisa. Today I have a good friend as our guest. John Bruggemann is a senior wealth advisor here at the Advisors Capital Management, and he's a good friend. And I've heard John speak a bunch of times, talk about financial matters, and I just knew that it would be great to get John here to get his input and give everybody a little bit of sense of John's knowledge here. But John, why don't you start off and tell us what you do and tell us a little bit about Advisors Capital Management.
Sure. Good afternoon, everyone. Thank you for joining us. My name is John Bruggemann. I am a certified financial planner and senior wealth advisor at Advisors Capital Management. My firm is really a family-owned business in Ridgewood, New Jersey. Founded by Dr. Charles Lieberman, who in previous lives before founding the firm, he was the chief economist at Chase Bank, and he worked on the policy setting board at the Federal Reserve of New York. So Chuck is a PhD, obviously, with Dr. Lieberman. He runs the firm. He is our chief investment officer and the head of our investment committee. My firm is an independent registered investment advisor. That's a mouthful, but I'm not allowed to use acronyms and say RIA. But that's what we are. And what does that mean? It means we're a fiduciary. I am obligated to act in the best interests of my clients. We do not sell products. We do not sell commissionable products. So the advice and the investments that I place my clients in is very transparent. We have a 1% management fee on assets under management, and that is how my firm pays me.
What happened last year? What happened in the markets, and how has that helped or affected your clients for this year and the future?
Well, we all know that 2022 was a year we'd like to forget. It was a very bad year for the markets, for the stock market, for the bond market. And that was caused by inflation. We all know that. We all go to the stores, drive cars. You folks hire people and saw the cost of wages to go much higher than you're used to. And that inflation is very detrimental to the economy in the long term. So the Federal Reserve, in an effort to bring down inflation, raised interest rates. And it sounds draconian, but what the Federal Reserve wants to do is they want to slow down the economy in an effort to bring price pressures under control, to lower inflation. And the only way they can do this is by raising interest rates. So we all have seen it. We've all seen higher interest rates if you're going for a mortgage or a business loan or what have you. We've seen higher interest rates in an effort to slow the economy. Well, a slower economy brings about lower corporate profits, and corporate profits are what drives stock prices. So higher interest rates, slower economy leads to lower corporate profits. The fear of recession and lower corporate profits leads to lower stock prices. We saw this happen. In 2022, the S&P 500 was down 18%. The most we've been down in a single year since the financial crisis. So it's been a while since we were there. As a planner, I encourage my clients, and I would encourage anybody, to keep a cash reserve, that emergency fund that's equal to about 1 year's worth of living expenses. And if you're someone that relies on your investment portfolio for income, maybe you're taking out $2,000 a month from your investments, and the market's going down, that's the wrong time to be selling stocks to raise that money for your income needs. So that's where you would pivot and lean on your cash reserves. And that will reduce your dependence on stocks for income and bide you some time for the market to come back. and markets always come back. Don't ever forget that. We've had some pretty bad things happen in my time in the financial markets dating back to 1986. We had a war in Iraq in the early 90s. We had some currency crisis in the mid 90s. God knows we had a bad 2001 with the 9/11 attacks. We had a real estate bubble burst and caused the greatest financial crisis we've had since the Great Depression in 2008 and 2009. And we all know that we had a world-stopping pandemic in 2020. All those events and many others in between saw the market sell off and, most importantly, recover and make new highs. And I have no doubt in my mind that the markets will recover from the bad 2022 that we had. It may take a little bit of time, but if you look at everything from a long-term perspective, yes, 2022 was bad. But if you take your performance in a 5-year capsule, you probably did pretty well over 5 years. You have 4 good years and 1 bad year. So take everything in stride. Don't look at the short-term performance or short-term volatility, and focus on the long-term and your long-term plan.
Wow. Well, a lot of our listeners are jewelry store owners, managers, and so forth. Some of them are small businesses, some of them are medium sized, and maybe we got some larger companies that listen in. But for the business owner, with what's going on in the world, what kind of advice do you have for them?
Depending on the size of the business, the one advice is I want to make sure that business owners are taking the proper steps to have the right retirement plan in place to where they could maximize the benefits under the current IRS rules. Something like a cash balance plan, which could allow the business owner to really save an extraordinary amount of money into a retirement account and tax-deductible contributions, 6 figures, if the income supports it. And a lot of business owners miss this opportunity. They maybe neglect contributing to a retirement account or in other accounts that don't allow the full benefit. So every business is different, and every business has different parameters and different opportunities. But certainly you want to make sure that you're maximizing what you have at your disposal, because that will reduce your taxable income. And we all know that the 2017 tax law legislation that was passed is starting to sunset, especially for these S corporations, these pass-through companies. I'm not an accountant, but I will tell you that a lot of those expenses that S corporations, these pass-throughs enjoyed, are going to start to sunset, and that's going to mean a higher tax bill for small business owners. So you want to take advantage of anything that could lower your taxable income.
Wow. Lisa, I was just curious, how are you doing in the world of your own personal financial planning? Is everything? Have you been doing well? Have you think you've been keeping up with what you should be doing? I know I haven't, and a lot of people probably need help here.
Yeah, I think you're right. I think we all were looking at our financial situation from the last year. Talk about being just so depressed. John, I lost 30,000 last year, and you have to look at it over. I've been, putting in my IRAs for decades. What encouraging words could you tell me that, just again, hold tight, but here I've $30,000 just boom, right out of my IRA.
It's real money. What can I tell you? Well, the easiest advice to give and the hardest to accept is just to stay invested.
Yeah.
One thing we cannot do, anybody cannot do, is time the market. And when you see the market going down and you get your monthly statement, and I stopped looking at mine in the middle of 2022.
Right.
I'm right there with you.
Terrible.
But the worst decisions we make are when emotion is involved. And you say, oh my God, I got to stop the bleeding. I just have to sell. And that's the worst decision you can make because it's made out of emotion. It's irrational. And there's this study. I'm not big into studies and statistics and all that, but there is a study which over 30 years, the return on the S&P might be, let's say, annualized 8 or 9%. And the return the individual investor received was 4%. And the reason for that is the individual investor sold at the absolute wrong time and the lows out of emotion and bought back into the market at the absolute wrong time when stock prices were higher. Because markets always do recover. And that's the little hope I can give you is they do. Think of 9/11. I was there that day. I saw probably, the worst day I could ever imagine. I thought that was the end of the world.
Yeah.
It really did. And guess what? The markets came back. And in 2008 and 2009, we had a horrible financial crisis. Again, thought that was the end of the banking system. And I had to give, I was a trader back then, and I had to give updates to our sales force economically every morning, give an economic update. And man, it was just depressing.
Sure.
Every day, another failure, another Fed bailout or whatever. But the markets came back and came back. I always use this as an example to my clients. On March, I think it was March 9th of 2009, the market was at its all-time low, or its low during that cycle. The S&P, and it's an easy number to remember, the S&P was at 666 on the index. Today, the S&P is at 4,100.
Wow.
That's a six-fold increase in 14 years. So markets, from the darkest times, markets always come back. Sometimes it takes this quick. Look at the pandemic. We shut down the economy. The economy shut down for 2 months. The market went down 30% before you could bat your eyelash. And guess what? We finished higher that year, 2020. The market roared back. I had clients say, should we sell? Should we sell? I have 141 clients. I had one client sell. And it was because his wife wouldn't leave him alone. He goes, I need to sleep at night. I have to go to cash. It was a mistake. But I could only advise.
Right.
But most of my clients took my advice and stayed invested. And that's my biggest piece of advice during adversity. Separate yourself from the volatility. I tell my clients, turn off the TV, turn off CNBC, and just focus on what you need to focus on, and let me worry about what I need to focus on your behalf.
Yeah.
Just curious, John, with the business owners out there listening to us, is there any advice that you can give that can help their employees or their people in order to kind of create a stronger financial future?
Well, it's almost the same advice I gave to the business owner that I would give to the employees is take advantage the best you can of retirement accounts. Younger employees have a very long runway to retirement, 40 years or more sometimes. I tell my kids the same thing. Just be disciplined, put in the same amount of money every month. Try not to look at your statements because it's really not that important. And just stay disciplined and invest X amount of dollars every month. And if you get a raise, increase your contribution. Okay, you're entitled to go out and click your heels and spend a little bit more somewhere else, but carve off a portion of that raise or increase in salary to increase your retirement contributions. That's very important for young people because the power of compounding, of having that money grow. Compounding is interest earned on interest over a 30 or 40 year period is amazing. And I teach a finance class at a local college, and I always ask my students, if you save $5,000 a year for 40 years, how much do you have at the end of 40 years? At 5%, a very conservative number. And they never get it right. But it's hundreds of thousands of dollars from being disciplined and saving that $500 a month.
Wow.
That's what I tell my 28-year-old. He's works for Sherwin-Williams, pretty big company, right?
Good company.
You know, at 28, I'm like, you know, really, you have to talk to these kids and tell them how important it is to sign on for those, you know, 401 or IRAs.
And
Start when you're young.
one other thing, Elise, if you work for a big company like Sherwin-Williams, they generally have a match to your 401k contribution.
Right.
They might contribute 3 or 4% of your salary as long as you're contributing. That's free money. Don't leave it on the table. So at the bare minimum, contribute up until the match. If you can't afford more than 4%, then at least contribute 4% because the company's going to match that.
Yeah.
And that's free money.
That is, yeah.
So don't leave it on the table.
You kind of mentioned it earlier, but wondering if there's any clear things that everyone should stay away from, pitfalls. Is there anything that you would say, run fast, run far away?
Yeah. Whatever the latest fad is, it could be Bitcoin still. I don't know.
Oh,
but don't invest in fads. Don't invest in the next greatest investment idea. You win by diversifying. And you win by investing in good, solid companies that have good, solid earnings prospects. That's how you win. You could have invested in Zoom in 2020, and the stock went from 30 to 400 and then went down to 60. So it depends when you bought, but it was a fad. It looked like it. It smelled like it. It was. We didn't invest in it here at Advisors Capital. We invested in growth companies that did well during the pandemic, but companies that will do well despite the pandemic, with or without. They have strong track records.
Right. Right. There's a lot of, I guess the message is to create a good, strong plan, stick with it. Don't get too emotional, and you know, just as long as you have a good plan in place, you know, and growth in growth companies, things should be pretty good in the long term. Is that
in the long run? Yes.
In the long run,
stick with the plan. Focus on 3 to 5 year increments, not 3 to 5 month increments.
What if somebody hasn't done a lot to plan for their future? What would you do? Say, does that change at various age brackets?
The better clients that I've had, the prospects that I've spoken to, are those that are still working. They're decent earners. They don't have to be high income earners, but decent. And they come to me and they say, look, I want to retire in 10 years. What's that going to look like? And there's a lot of factors I have to take into consideration. But one of the things I'm looking for is a savings rate. How much do you have in a retirement account? And how much can you put into a retirement account? And I take income and expenses out 30 or 40 years and show a client what their retirement will look like. And that plan, that cash flow analysis is going to dictate to me if you're going to make it or not. And if the prospect is 64 years old and says, I want to retire next year, and I ask, do you have retirement assets? And yeah, I have $8,000 in an IRA. So, okay, let's, you might have to work a little bit longer. But if you're 55 and you say that, it's not perfect, but at least you have time to make some adjustments and a pivot and get the person going in the right direction. And you have to manage expectations. I don't mean to hurt people's feelings, but if I suggest to my client or my prospect that you might have to work a little bit longer than you want to, it's for their own good. It's what the plan is telling me. It's what the analysis is telling me. And I could show them in real time on the software that I use that, okay, if you retire at 65, your money's going to take you to 79. But if you work 2 more years and save a little bit more in those 2 years, all of a sudden your money lasts you to 86. That's 7 years. That's real. So I could model that in to the cash flow analysis and demonstrate to clients that, look at this, 2 more years gets you 7 more years on the tail end. And it's a picture, it's a story with pictures, and clients could see that.
Mm-hmm.
Wow. How often, John, would you suggest people have someone look at their overall portfolio of their finances?
A minimum of once a year, suggested twice a year. And I do have clients that prefer quarterly, which is fine. I always tell my clients that there's no limit on my time. If quarterly is what they want, that's fine.
So
but definitely semi-annually is best.
Got it. Because to just make sure you're heading down the right direction and didn't make any wrong turns since the last time we spoke.
Right. The first question I'm going to ask in a client's review is, what changed?
Yeah.
What changed since the last time we spoke? Oh, I got a raise. Oh, I'm saving more. Oh, whatever. My kid's going back to college and I got to pay for part of it. Something changes, and if it affects the cash flow, I have to know that. And I have to model whatever change was made. I have to model that into the analysis.
Got it. Is there ever a time in your life that you should just go really aggressive?
If you have the stomach for it, sure. But again, it's a long-term proposition. You can't expect to go really aggressive in April with plans of selling in July. You have to look at the macroeconomic backdrop. In 2019, 2020, I would say to clients, the wind is at our back. We have a good tailwind in terms of low interest rates and accommodative fiscal policy. We had the tax law that was put into place in early 2018. We really had the wind at our backs. And if you see that and you get the right advice, you could afford to take a little bit more risk. But that was a once in a lifetime. Hopefully it comes around again, because a lot of people made a lot of money without taking a whole lot of risk.
Yeah.
Right. Elisa, you think the jewelry industry is very active and proactive in terms of making sure, the financial future is kind of, secure?
I'm sorry. Go ahead. I was just going to say,
the little I know about the jewelry industry is it's got to be cyclical.
Absolutely.
If incomes are higher, sales are going to be higher, and if the economy slows down and incomes are lower, it's going to affect sales for the jewelry industry in general. But people are still going to get engaged. People are still going to have 25th anniversaries. So there's always going to be an underlying demand, but discretionary income is going to increase as incomes increase. So you got to make hay while the sun shines. You got to take advantage of those good years and prepare for those not so good years.
Right. Exactly.
Well, I don't know if some of the stores in the jewelry industry are, their sales, maybe there's a $500,000 store. A few towns over, there could be a $3 million store. The advice, I'm assuming, is the same for both, but do you see a difference in, say a higher end business than you do, say, are the employees or what have you putting in more when they're working for, larger corporations than, say, a small mom and pop who may just make $500,000 a year, which is nothing. I mean, is there advice for people that are maybe like, oh, I can't hire a financial advisor. We're just a small mom and pop store and we do less than $1 million a year. Any advice for those people who need to reach out? I think in our industry, those $1 million and less stores are really in need of financial advisement, more so than the higher, $2 million, $3 million stores. Is your advice for both of them the same, or is it different?
there might be more opportunities for the larger volume stores or the larger revenue stores to
Right.
take advantage of. But at the same time, it's still that person or that business owner's money, whether
Yeah.
it's a $500,000 or $3 million. It still has to be treated in the same way. I can't differentiate between clients because one client has $3 million and the other client has $300,000. That wouldn't be a fiduciary, right? I'd be catering to somebody who has a bigger fee as opposed to somebody that has a smaller fee.
Mm.
And the same way with the business, you just whatever you have is yours. And yes, you need to hire. If you can't do it yourself, you need to hire a professional to guide you. And the fee is well worth it. The 1% that we charge, I could come back in multiples with the advice that we give. If people look at the fee without looking at the underlying value for that fee, it's very difficult to have a good relationship.
Right.
You have to see the value, and the value is there for anybody, no matter what the business size is.
Got
Interesting.
it.
Yeah.
So, yeah, I mean, really, I think I talked to a lot of small jewelry store owners, and the term "mom and pop" really puts it well. And husband and wife is really working most of the shift, and maybe they got a full timer and part timer, but they're really working hard to make sure the store survives and that they can earn a living, And in those cases, their primary goal is probably just to keep it going, keep paying the bills and expenses, and probably thinking I'll get to my financial future at some point. I've heard that kind of similar story and before, and there's probably a lot of people in the jewelry industry, jewelry store owners that have that mindset because they're working hard trying to grow it.
All right, seeing somebody like me is like going to the dentist. You put it off. Life is good. My teeth aren't bothering me. I don't need to see somebody. But eventually, your teeth start falling out, and then you have to go to the dentist, and then it's too late. So it's I am not on the top of everyone's to-do list as much as people like myself should be.
So it's the necessary evil, but you better get ready and go in there and get it done.
And just like the dentist says, it's not going to hurt.
Oh, right. This doesn't hurt. Just stop. Yeah.
No root canals, John?
No root canals.
All right. Well, every time I hear you talk about some topic, there's always some tidbits of wisdom that I hear, and that's why I thought it would be good for you to come on here, just talk about people paying attention to their financial portfolio and making sure that they're set. Maybe they're okay now, but how's that going to look like in 10 years and 20 years? And you can't worry about that when you're.
And it's more than just investments, as you well know, Guy.
Right. Yeah.
The financial planning wheel, so to speak, has many spokes. And investments is an important part. It's an important spoke, but it's not the only one. There's protection, there's insurance, there's estate planning, super important. That people have just the right documents in place, and a larger business might have succession plans to leave the business to their children. Everything has to be written down. Everything has to be in documents to create less of a mess when the owners pass on. Trusts are a big part of that.
Yeah.
And I'm not an attorney. We don't write the paperwork, but we guide clients in choosing the right vehicles in order to make their wishes known and to pass on the business the way they want to pass on in the most efficient manner.
Wow. Yep. There's certainly a lot to know. And a lot of times with the people in the industry, we're talking about diamonds and gold and managing, payroll or whatever it is a business owner thinks about. But this is really important stuff that a lot of not just people in the jewelry industry need to know, but everyone needs to pay attention to, so that we, so we can don't have to work till we're 80 and.
It's something you could delegate to somebody like me. It's what we do for a living. Allows the business owner to focus on what he knows and does best. There's an old term in economics called specialization. And it rings so true that people should specialize in what they do best and allow others to do for them what they can't do best.
Yep.
And as long as it's economically feasible and viable and value can be seen in the service that you're receiving, it's a no-brainer.
Right. Sounds good, John. How
Good advice.
Yeah, definitely great advice. When if somebody has any additional questions, you mentioned something here, and somebody wants to reach out. How does somebody get a hold of you?
Email is best because I'm not always available for a call.
Got it.
Email is the best way to start the conversation, and then we would schedule a call.
Okay.
Because it's a lot easier. I'm a horrible typer, so it's a lot easier to receive an email and say, hey, do you have some free time later on today at, let's say, 4:30? Got
it. We're going to include the email on the episode. Is john.bruggemann@advisorscenter.com, if I got that right. And we'll include the email, but the website is acmwealth.com. Okay,
that's correct.
And what's your phone number if people just wanted to call you? Do the old-fashioned way.
My office number is 201-447-3400, and you just ask for John. I'm the only John in the office.
All right. And like I said, I've known you for a while, and you're always open to help and answer some questions. Well, I certainly appreciate you coming on here, John, and just sharing a little bit of wisdom.
Much appreciated. Thank you.
Yeah. So, well, Elisa, you have any other final questions for John? Or
I don't. I was going to ask John, is there an office like for some of our listeners that may want to come in and see you, or are you doing? Where are you located, and what part of the United States?
We're in Ridgewood, New Jersey.
Okay.
Which is in Bergen County. We're 25 miles outside of Manhattan. I am talking to you from my office. I come in the office every day, and I do meet with clients and prospects face to face when the opportunity presents itself.
Right.
Okay. All right.
You work with clients across the country, right, John?
If the opportunity is right, I'll get on an airplane.
There you go.
Got it. Well, John, thank you so much for joining us and answering some questions, sharing some knowledge. Certainly appreciate it. Elisa, It's always a pleasure, of course.
Thanks for having me. Yeah, thank you. Great information. You guys make sure you follow that advice. That's good pearls of wisdom, and give John a call. Also, Jewelry Store Marketing. And as always, this episode is brought to you by
Southern Jewelry News.
There you go.
Mid-America Jewelry News. So
yeah.
Perfect. Thank you, guys.
Thank you.
A lot. All right.
Take care now.
Thanks for listening to the Pearls of Wisdom Jewelry Podcast. For more information about the show, please visit southernjewelrynews.com/podcast, brought to you by Southern Jewelry News and Jewelry Store Marketers. Make sure to subscribe on your favorite podcast platform so you can catch the next show. See you then.